not gonna lie, and I've introduced some pretty cool people, and we're gonna introduce some cooler people. But like, I'm not gonna lie, this next panel kind of intimidates me. More importantly, because of what they may say about me and or us come the next Sunday morning. And so I will just say, Kiah, you have a very tough job ahead of you, sort of trying to manage this group of troublemakers. So thank you so much. I would argue, as everything evolves, as do where we all get our information, and I just give all of you credit for, number one, not just pushing information out, but doing the research, being a part of the ecosystem that you're commenting on. So really thank you all for being here.
I would like to call my panel up. My name is Kiah Haslett. I am the Banking and Fintech Editor at Bank Director. As they enter, would you mind introducing yourself, gentlemen, and saying your firm or the name of your newsletter?
Yeah, sure. Hello, everybody. I'm Simon Taylor, best known for Fintech Brain Food, the newsletter, and I work at Sardine, the fraud and compliance startup that you should all work with.
I'm Jason Mikula, head of industry strategy for banking and fintech at next-gen decision platform Taktile and publisher of Fintech Business Weekly. And I have a forthcoming book that my publisher says I'm legally obligated to plug during this panel.
Wow, I don't have anything to plug.
You always have things to plug.
That's true. Alex Johnson, I write the Fintech Takes newsletter.
Jonah, I'm a partner at a consulting firm called Klaros Group based here in DC, and being on a panel with some of the key spokesmen of our industry, I'm just going to open my popcorn, sit back, and enjoy the show. I got the popcorn.
Before you start eating into a mic, Jonah, we actually did have some news break during this conference. It became public that Chair Grunberg will be resigning on January 19th. My first question for you, since we have to talk, okay. That wasn't for me. My first question for you, Jonah, is what does this mean for some of the rule promulgation we've seen from the FDIC, thinking broker deposits, thinking the reconciliation role?
Sure. Well, now I have to speak, so no popcorn. Okay. So I think, let's start with the rules real quick. I think broker deposits, deader than dead. That might have been true anyway. I think the record-keeping rule will survive. There may be tweaks. I think it's widely expected that Vice Chair Travis Hill will ascend to become chairman of the FDIC. He voted for the proposal and offered some, I think, constructive suggestions in his remarks in approving the proposal. So I think I would expect that to move forward. Of course, nominations is a bit of a roulette wheel and a guessing game these days, so I wouldn't take anything for granted in terms of who's going to ascend to run the agencies, but that's the current betting, and if he's going to ascend, then I would expect that rule to move forward. I think, the FDIC's rules and guidance around, signage and deposit insurance disclosures are also not, I think, not overwhelmingly controversial and are things I would expect to continue to see moving forward. I think the harder questions are around sort of the broader initiatives that the regulators have been working on. What do they do in response to the RFI and the responses that they got to all of that? Will we see more guidance? Will the FDIC sort of launch or relaunch sort of a fintech office? Will they decide to go down the path of having a novel activity supervision program like the Fed and the OCC do? I think those are all outstanding questions, and we'll have to see what the new chair at the FDIC decides to make a priority. And the only thing I'd remind people is that, the FDIC is an interesting construct. It's a board. Yeah. And so who lands at the CFPB and who lands at the OCC will matter as well, because they will be board members at the FDIC as well.
Did anyone want to weigh in also on their thoughts on maybe agency changes overall or rules that we might see from regulators as we have the agency shifts?
I mean, something that I am curious to see, you mentioned, perhaps the FDIC or other agencies, spinning back up some of these innovation offices or fintech offices. I am kind of curious to what extent industry may be reluctant to engage if there's a perception that these are sort of temporary, they're there during one administration, but not, potentially not there if there is a change of party and control or change of administration. And does that undermine the credibility that private industry ascribes to these, quote unquote, innovation offices?
Yeah. So Jason, you recently flagged in Marqeta's earnings call that the launch of new fintech partnership programs is growing to about 300 days, and this was received as bad news across the industry. Given that, what do you think this says about the outlook for fintechs and their ability to launch bank partnerships? Is this too much time? And then was the sell-off a reasonable response?
I mean, I do like to always caveat that I am not an equities analyst, and I try not to play one even on Twitter. It's hard to predict why markets react the way they do. I mean, as far as I think the more important question of, how do we contextualize, Marqeta saying, it used to take us 150 days to launch a program, and now it takes 300 days to launch a program. Is that, the right amount of time? I realize this is a non-answer answer, but I mean, the right amount of time is dependent on the type of program and the types of risks that program entails. So for example, having a sort of vanilla neobank that is consumers that are only located in the US with, typical KYC processes reasonably could have a faster onboarding process than, say, a company offering business bank accounts to companies located in Ukraine, right? So looking at one single number, I guess it at least tells you directionally, it at its peak was taking twice as long as it had previously, and that, is reasonable to understand as a response to the quote-unquote heightened regulatory scrutiny that I think we're still seeing.
Simon, what about you? Do you think 300 days is too long and 100 is probably closer to correct? Or do you think and what do you think going forward if that number fell or increased?
It's an arbitrary number. I don't like arbitrary time periods, but time is your enemy as an entrepreneur, and it is your friend as a risk manager.
Sure.
And the problem is, the biggest risk is we have no innovation in the business. We have no, in the economy whatsoever. The easiest way to have zero fraud, zero anti-money laundering is to do nothing. Well, that's probably not a good outcome for consumers or the economy or everything else. So we have to find a balance. And I think that's about setting a high watermark of what do we expect and how can we use technology and automation to do that. So, I often like to joke that from the UK, I'm the ghost of fintech future. And we had faster payments for a while. I can tell you there'll be scams. But the other thing that the UK did quite well was launch de novo charters for fintechs. We built a path for the larger companies to get charters. Not saying that the market's perfect, but and then we have the EMI framework. I would actually like to see, rather than just, and I don't mean to poo-poo them, I think innovation officers are crucial, but that we have the serious policy movement. And I know that's making a wish. We're close to the holidays. But it would be nice to see that serious policy movement if I was a fintech company.
Well, Alex, I know you closely watch the CFPB. What have you gathered from the CFPB's involvement in 2 recent consent orders involving bank partnerships, Vistar and Apple? And what do you kind of expect maybe going forward, or what would you maybe be concerned about or excited about from the CFPB?
Concerned and excited. Well, I think the earlier question you asked about what might change over the next 4 years, I mean, it's easy to sort of forget this, but the CFPB is really young relative to other agencies, and I think that's the other thing that I notice when I observe how it changes administration to administration, is it doesn't have the same sort of culture, right? Like, there was a story in the Wall Street Journal, I think, about the OCC fighting to get a portrait back from, was it the Fed or Treasury? Like that's the kind of problem you have when you're 150 years old. The CFPB doesn't have that problem, right? And so the culture and the priorities and the approach to dealing with industry and interfacing and doing things like innovation sandboxes, all of that changes dramatically. So I think the CFPB is the agency to watch in a lot of ways in terms of what's going to change. The Vistar and Apple consent orders were really interesting, right? Because while they weren't nearly as dramatic as the Synapse situation, they sort of fit into the same phylum, if you will, in that it sort of is this illustration that operational problems in the day of digital banking, when this is the way we access our financial services, operational problems, even if they're minor, are compliance problems, right? There's no daylight between those two things. And so if you rush, or you're sloppy, or you choose the wrong partner, you choose the wrong vendor, and those mistakes end up impairing access for consumers, you have a problem, right? And I think the CFPB, from a consumer protection standpoint, sort of somewhat broke new ground in sort of interpreting those outcomes that way. I also think the other thing that those consent orders illustrate, and the details, if you read them, are pretty interesting about like Goldman Sachs rushing to get the Apple Card into production because they didn't want to get fined by Apple, right, if it was longer than 90 days, or the fact that Vistar wanted to avoid paying the next installment of their contract with their legacy vendor, so they wanted to get off of that one. And oh, by the way, they also had a $20 million investment in Nimbus, which might have tilted the scales a little bit in terms of which provider they picked. All of those details illustrate, I think, what the CFPB would consider to be conflicts of interest. Yeah. And this is very different than the sort of traditional model envisioned by third-party risk management, where it's the buyer of the software that has the leverage in that relationship. In the case of Apple and Goldman Sachs, that was not the case. Apple was the one that had the leverage. And then arguably, to a degree at least, Nimbus had some leverage as well. And so I think the CFPB is trying to look very closely at those areas.
Does anyone else want to comment on maybe the designation of Apple as a significant service provider that was potentially tilting the scale around who had what, who was making what calls, or on what timelines were we operating on?
I mean, it certainly was notable that Apple entered into a separate consent order apart from the one that Goldman entered into for the same underlying fact pattern. And sort of drawing the contrast with the other action that you mentioned, like that was not the case with Nimbus in Vistar. Now, sort of, you know, why and what, you know, what kind of point is the CFPB or Rohit Chopra specifically like trying to get across vis-a-vis like the CFPB's posture when it comes to big tech? I don't want to.
Not a huge fan.
I don't want to put too many words in his mouth, but I mean, I think you can sort of draw a reasonable conclusion that, you know, that has been a target. What does that look like in, you know, the next administration with a different director? Yeah. Who knows?
Yeah. I was putting on my bank nerd hat, very interested in the words significant service provider, because and I know there's been a lot of talk about the BSC. I've heard there's been a lot of talk about that, but that there's also a significant service provider exam that I know that the FDIC runs, because they have received feedback from their OIG that this exam is ineffective or has deficiencies in it. So this is almost another way that I can see the supervisory parameter expanding, but and regulators, financial regulators, being able to get into more non-banks or to go after non-banks for practices. And Jonah, I know we've talked a little bit about these consent orders. Do you have any takeaways or lessons that you would advise Klaros' clients when we come to, you know, kind of how these consent orders fit into all the other consent orders we've seen from prudential regulators?
Sure. I mean, a lot of the key points have been made, so I'll just sort of touch on them quickly. One, I mean, just as a policy matter to start with, like the Bureau was created in large part to create, you know, consistent consumer protection across banks and non-banks. I mean, that was one of the really novel things about the Bureau, and so I think they're very much doing their job if they think that Apple has, you know, taken steps that leads to consumer harm. I think, you know, Alex, you drew the connection between operational risk and compliance risk. It's broader than that. I mean, this is operational risk and consumer harm.
Yeah.
Yes, the compliance risk and the regulators coming and knocking on your door is a risk there, but you really need to be thinking about that. And I think that direct connection was really interesting and important to make, and it's something that, you know, I look at as something of a case study now. And then, you know, that really brings to fore the incentives and the contracting dynamics in these situations. And, you know, you really have to have a slightly more enlightened view of your own self-interest if you're entering into these relationships, and like pushing Goldman to launch really fast, even if they haven't figured out Reg E dispute handling, like might not be in your own self-interest in the long run. So, you know, I think there are some really instructive things in there. I mean, at some level they boil down to common sense, but it's really easy to sort of forget about that unless you step back and say, what's the broader point here, and really focus on the consumer harm. It is, you know, there are historical precedents. I mean, this is not the first time that non-banks have been, you know, the subject of enforcement actions like this. There was the Rush Card incident several years ago. Hire One before that was a program of then MetaBank, and there were direct enforcement actions brought against MetaBank. So against Hire One for their program with MetaBank. So I wouldn't be surprised if supervision is not the only way that some of these additional authorities of the bank services company are leveraged, and that institutionally affiliated parties, for lawyers in the room, get brought into the enforcement action space a little bit more. That may be more tractable than having to supervise everybody, but we can come back to that.
We'll come back to what might happen at bank regulators, but one type of consumer harm that we're seeing playing out in the fintech partnership space is that consumers don't understand the difference between a bank and a fintech, and they don't know when and why FDIC rules would apply. Jason, what has your reporting on Synapse's bankruptcy shown you about consumer awareness, and what might be appropriate responses to this, and how should banks and fintechs in the room think about what consumers know?
Yeah, I mean, for folks who followed my work or who are also on the conference circuit, this probably won't be like a alarmingly new thing to hear. I do think that your quote unquote average consumer has a very difficult time parsing the difference between a bank and something that is not a bank but provides features and services and capabilities that are bank-like. I mean, the way that I illustrate this is, imagine opening up the App Store and looking at Chime, which is not a bank, but partners with Bancorp and Stride, looking at Cash App, and looking at Vero, which is in fact an OCC chartered bank. If you put those three apps in front of our imaginary everyday
Your average
user,
Joe, yeah.
I would venture to guess that they would not be able to parse the difference between these three things. Yeah. And so then from a public policy standpoint, the question becomes, what is the right way to handle that? Yeah. And the current consensus seems to be something along the lines of an asterisk that says company X is not a bank, it is a fintech company, banking services provided by a banking partner, blah, blah, blah. The problem is that doesn't mean anything to the kind of people who are not sitting in this room. And is this something that you can actually just sort of disclose and informed consent your way out of?
And is that enough, really? Like, is that sufficient when you read these like yada letters and they're like, I know I was told, but I didn't know what that meant, and how much money should I have put in yada?
Yeah, I mean, the last thing I'll say on this, at least for now, is, and I don't mean to pick on Chime, I think Chime is generally a good and well-run company, but imagine calling up Chime or any other company that is in that segment and asking the questions you would need to know the answer to understand if pass-through insurance would apply. Like, hello, customer service person, if I can even get you on the phone, are you maintaining books and records like adequately? Can I look at those? Yeah. How is the account at the bank titled? Is it titled correctly? Mm-hmm. Those are questions that not only does an average consumer not know to ask, they wouldn't be able to get the answer even if they did ask the question.
Right. You can't get it now from your bank. Simon, what do you think?
Consumers generally don't understand most things in finance. I think that's just a broader point. No, but like the surveys on APY, I mean, if you really wanted to understand what you're going to end up paying, you're better off pricing loans in dollar amounts than you are pricing it in APYs, even though that doesn't account for compounding, which is why we price in APYs. But this is why a lot of companies have issues with the way things are marketed, because they know from the surveys, users don't understand the way regulators force them to communicate, or law forces them to communicate. So there has to be a middle ground where you have the plain English as the beginning, and then the double click of the disclosures underneath it. And a lot of effort and energy has gone into how you can describe things in plain English in marketing. Where people get tripped up is when they break the Mikula rule, which is, oh, but you didn't have the disclosures in place properly. I do think it would be helpful to have some standards on what the disclosures should be, but it would be more helpful to have a conversation about what's effective. What's actually going to work. Somewhere along the lines, we lost the importance of effectiveness in policy and the importance of effectiveness in regulation, and building that feedback loop of what did people understand, and therefore what should practices start to look like. Again, I'm making crazy wishes today, so I'm gonna make another crazy wish.
Alex, what would you say to Simon?
Yeah, I mean, I don't at all disagree. I mean, the need for effective disclosures with consumers, I think, is really important. But going back to, like, again, I'll just pick on Chime as one example, and then Yada at the other end. It struck me as very insane that there were people who had their life savings in Yada, right? But what I realized kind of post-fact after that all happened was, working in fintech, I could distinguish the difference between Chime, a very serious at-scale fintech company with a lot of the sort of protections and processes and operations built into it, and Yada, which was just much smaller, right, and was maybe making some choices that weren't as wise. But I think, Jason, you illustrated it great with the just App Store. We flattened out the entire experience for shopping for this stuff, right? And I think that in a broad sense, one of the challenges is digital just wipes away all the distinctions we used to have around shopping for products. Right now, everyone shops on Credit Karma or Bankrate or wherever you get that information. And by the way, those contests are all rigged because people are paying to be at the top of those lists. But even if they weren't, there is no meaningful way to distinguish those under the surface risks or challenges. And so I wish I had a good answer, but I think the problem we're wrestling with is distribution has flattened, but a lot of the rules and ways that we expect consumers to navigate the market are stuck in a different century.
Very briefly, sorry, Kiah, but there are policy solutions that are possible here. If you look at the EMI regime, I know we've been talking about a federal MTL forever, but actually if you could get that done, then it's very clear what the protections are. And in that regime, you're not allowed to call something a bank account unless you are a bank. You can call it an account. This is not beyond the wit, it's just kind of executing it. So.
Simon, do you think under the second Trump presidency and a supermajority in Congress, we're gonna get a fintech charter?
I'm making wishes all day. I'm making wishes all day, so that's my biggest one.
Anyone else think we're getting a fintech charter in the next 4 years?
Yeah, can I take the other side of that one? And it's not, I wrote a whole piece that got me in a lot of trouble with various folks about
through Congress, all things are possible, right?
All things are possible. I think one of the challenges is that there's just a coordination issue, right? And Simon, I wish we had a simplified structure like you all do in the UK, but we just have so many different agencies, and this doesn't even bring in kind of the state level part of the argument, but even at a federal level, it's very difficult to figure out who should play what role and to get agreement on that. And so I would tend to find it less likely, but again, my wishes are with Simon for sure.
The only thing I'd say on the slightly serious point is, but you could still take the ideas from that model and implement it through the soup that is there. So for example, you can't call something a bank account unless it is issued directly by a bank. And that becomes something
Credit unions also sometimes run into that bank account issue, actually.
Yeah, right. And people do call it a bank account in their marketing. And that's actually something from a consumer perspective. If I see the word bank, I know I'm dealing with a bank. Those things can be helpful. How do you simplify?
Anyone else want to comment on Simon's wish list that he's making?
I mean, I think the question on a federal payments charter, legislation seems somewhat dubious. There's not been a lot of groundwork laid, right? I mean, Treasury gave a speech like 3 weeks before the election saying, hey, this idea that we first put in a report 2 years ago is kind of interesting, and they didn't add many details to it, which suggests they hadn't put a lot of legwork into trying to move anything. So I think the question is really, will somebody want to take another run at creating a federal payments bank in a different charter construct, maybe an OCC special purpose national bank, and that person will have to be brave enough to know that there will be litigation over that charter just as there was over the non-depository version of a special purpose national bank a few years ago. So that'll be the interesting question. And the states, of course, have innovated in a number of ways, and different states have innovated with different kinds of charters that may be leveraged for something like that, but they don't promise you a national market without the need to get other licenses. So I think that's, we'll see if somebody emerges to try to push something at the federal level without legislation, but I would assume that we'll have to go to court.
So there has been some discussion even today about operating standards for fintechs. What is this panel's take on operating standards in 2024? What can and can't standards achieve that the industry needs? And what is one standard you would like to see? Jonah?
Ooh, come back to me for the last one. I think...
and you can't pick someone else's standard. That's the rule.
Yeah, okay. Look, I think this is a really critical moment, and there's a lot of discussion about standards. I think in reality, I like to talk about best practices, and I think there are things that we might reasonably call standards that fit within that, but there's really a broad scope of things on which I think it would be really helpful for the industry to get together and sort of decide what good looks like in this space. What kind of information does the bank need to get? How often? Who needs to be doing what when it comes to the very long checklist of things that have to happen in these partnerships, right? I mean, we have checklists that are, hundreds of lines long in spreadsheets, and we don't always even get to the task level. So this is not trivial, and I think, having some broader discussion around who's doing what and what those best practices are, and in some of those areas, standards will be important. How do we share data? Are there specific data formats, et cetera, that we can use? And this will become more important because more fintechs are going to work on top of multiple banks, not just one. And so the more consistency we have, the better. And if the industry is all doing things in a certain way, I think that becomes easier for the regulators to look at and understand and say, you know what, I think this works. And right now, that's what they're missing. The regulators are kind of trying to figure out what good looks like. And they've been trying that, they've been working at it for years, and now is really a moment. And you saw this with the RFI. It's the reason they put the RFI out. I think they're eager for ideas and examples, and so I think this is really a moment not to be missed in terms of trying to put some stuff on the table. So we've been working with AIR, the Alliance for Innovative Regulation. There's a mini tech sprint tomorrow that AFC is helpfully co-sponsoring. There's a bigger tech sprint in February around these issues, and I think that's just one of many efforts. There are others. I think people should get involved and get to the table. I'll think about a specific one.
Simon, what would you say?
I want to just make the data sharing one really, really kind of clear. So a lot of, I think it's Jonah's league table of the consent orders that have happened for third-party risk management as being one key area. The other one is anti-money laundering. It's always the stick that you hit a bank with because there's always somebody that's got an AML failing, because AML is incredibly hard to do well. And it's even harder when you're reliant on I'm a bank and I'm reliant on somebody else to implement the policy. And I've written down a policy, but I don't know if they're following it. So how do I make sure that I have some sort of visibility into that? So not only would it be helpful to know what data needs to get shared just for that one specific risk, but to have real-time visibility into that data, rather than, there's a sanctions alert. So somebody builds a suspicious activity report and a UAR, and then what do? They turn it into a PDF and a CSV and email it to the bank, so somebody has to try and figure out what that means and match it all up. This is the reality of the compliance job. It's incredibly hard. It's one of the things I'm passionate about. At Sardine, we do that. I know many of our competitors do. We help with that stuff. But it shouldn't be like just a couple of tech providers saying, here's how you should do it. Those best practices, CFES is another one with FS Vector that are trying to put together best practices, should also include, so what does this look like when it's good? What does that actually look like? So practical examples of what good looks like best practice sounds like you should do these things. But I think it's so much easier when you give people a use case, because it's like, oh, you mean that?
Yeah. Jason?
Yeah, I mean, I stop and ask myself, what is the point, or what is the goal that having, whether we call it best practices or a standard-setting org or like a self-regulatory organization, which are three distinct things, but if we're picking from some
anything, literally
menu
anything,
of these things, sort of why would industry want to do this? And the first answer I always jump to is to attempt to head off perhaps more burdensome regulation.
Yeah, that's fair.
The piece I struggle with fintech standard setting or what have you in the U.S. is, it's at this point it feels like too little, too late. There's been such a significant amount of consumer harm. Obviously, the Synapse situation is the most eye-catching, but there's plenty of additional examples, I guess maybe you have a bit of a reset with the change in administration, and perhaps that provides an opening. But if the point is to try to discourage more burdensome regulation by demonstrating that an industry can, self-regulate, it's a little bit late for that.
Do you have any suggestions, or
do I have
do you
any
have a standard suggestion?
I mean,
Based on your reporting?
put on the spot, I guess I would have to loosely co-sign the idea of the synapse rule, or the, what is the very long title? Custodial accounts with transaction features.
Oh, you guys are nerds.
I mean, I'm being a bit pithy, but I mean something in there as far as if you are using a third-party vendor to fulfill a mission-critical function, which I assume probably all banks do, that there is the proper level of due diligence, TPRM, et cetera, of that vendor. And when stuff blows up, you don't just say, well, the contract I had with that company over there said that they were responsible for ledgering, reconciling, and actually making sure the money was in the account that the money was supposed to be in. You know, just because it was in the contract doesn't mean your vendor's doing it, clearly.
Alex, what standard would you like to see? Or I'll remind you that you want fintechs to pay deposit insurance if you'd like to talk about that for a second.
Yeah.
I'm friends with everyone in the audience.
I know, I was trying to be popular on Twitter.
The broker
that day.
deposit rule would have taken care of that, just
yeah,
FYI.
Yeah. I mean, so on the standards thing, just real quick, I think the important thing is actually not standards, even though those are important. I think best practices, like, I mean, the rule that you just mentioned, the long name of, like, pretty common sense. Like, I think we probably all should have been doing this. So it's not as much the best practices, although codifying those are important. It's certification, right? How do we know that you're doing this? Who's allowed to certify that you are meeting these standards? And that's really important, right? Because if you look at existing regimes for doing this, whether it's SOC 1 and 2 or PCI or what have you, they all have different approaches to certification. And the goal is you want to make it easy for people to get certified, right? You don't want to make it like burdensome or really expensive. At the same time, you also want to make sure anyone who's able to certify, how are we dealing with conflicts of interest? If it's a consulting firm that's allowed to certify that this fintech company is meeting these standards, is there some type of peer review process that makes sure that they're not showing favoritism to their customers? So there's a lot behind the scenes to work out with certification. And I think if you get the accountability mechanism right, the standards part, I think in a lot of ways is a little bit more straightforward. Real quickly on the FDIC insurance, the only thing I've sort of realized on that over time, and doesn't necessarily mean fintech should have to pay directly into the FDIC fund, but the FDIC Office of Resolution is like the fire department, right? Most of the time they sit around and they don't do anything, but when we need them on a Friday to jump in and resolve a failed bank over the weekend, they do that, right? And they do that extraordinarily well, and that's what creates trust. It's not even really so much the insurance fund, it's that resolution mechanism, right? That solves the problem, so when a consumer goes to use their debit card on Monday, it works, right? In cards, we have the same thing with interchange and all the systems that Visa and MasterCard have set up. That costs 2 to 3% of every transaction that merchants pay. So I do think as an industry, we need to talk more about the cost of trust and who is going to contribute to that cost. And when I think about standard setting and those kind of things, I also think about what is the cost sharing? Who's paying for that? My wish that I'd love to toss out into the universe is I'd love VCs to play a more active role in funding that, right? Because it's important for the ecosystem, and that cost is something we should be honest about.
I think VCs will be paying that.
They'll pay one way
because
or another.
their companies are going to have to, pay for these programs through banks, and these programs are going to be operated at higher standards. I think that's actually the exact right point, and it's why we should care so much right at this moment about standards, is because it is about trust, right? I mean, the Synapse situation was really unfortunate, and it was sort of everybody's worst fears about these models crystallized into one place. And I think, we need to, hopefully that catalyzes, sort of trying to get out ahead of it, not just more regulatory scrutiny, but, actually will people, will trust in this basic model disintegrate? Will people look at Chime and think twice next time, right? And I think, it'd be unfortunate if that were the outcome.
Long line of financial institutions still waiting to get into this model. So we risk repeating this time and time again. Why? 2 reasons. One, every bank wants to get off their existing core because they feel like they're beholden to it. And this becomes a way in which they could figure out, well, could this become our second core if we start with just this one business line? So that's a thing I hear quite often. And then the second thing is, and they're all fighting for deposits to remain relevant. As long as those things are true, then there will be lots more small banks at the door trying to get into this business model than there are those currently there having worked their way through consent orders and reached maturity. So standards are about prevention rather than cure, because prevention is a lot cheaper than cure.
So I was actually given the option to have audience questions, and I know this is a hot topic of conversation, and none of these guys work for a regulator or a bank. So does anyone have any questions they'd like the hive mind to answer?
Or do you want Kiah to rant about something?
No, we are running out of time, but I actually have been thinking a lot about what would it look like to have a fintech bankruptcy process, to your point about resolutions, and is it acceptable to have people's daily transactional accounts frozen between 3 weeks and 6 months? And is that a way that we could have, we could have some sort of framework without giving them fintech charters, which I don't think is going to happen. The other thing, too, is I like to think about, please, someone define what a bank service company is. Please also then promulgate a rule for the federal regulators by which we can understand how these fintechs how these bank service companies, would be supervised by them. But do you guys have any closing thoughts as we wrap up this panel?
I mean, I will echo what I understand to be your call for, let's say, greater transparency for how existing regulators and regulation treat and interact with fintechs that exist outside of the banking regulatory perimeter.
Yeah. Alex? We'll go all the way around and then come back.
Yeah, and I mean, I think that the plea I put out in my newsletter last week was please build cautiously over the next 4 years. I think it was Joe and Bloomberg who tossed out the idea of like Rumspringa, where we just throw the rules out the window for 4 years. I think that we are going to see an element of that. Crypto is an area that I'm concerned about. Lending might be another area. Just because the rules aren't being enforced for 4 years doesn't mean we don't know what the right thing to do is and the right thing to build. And the trust is when you build in a responsible way and when you don't have to. That's when trust is created. So that would be my hope for the next 4 years.
Jonah?
I mean, very similar. I mean, this is an important inflection point of sorts, and making sure we take advantage of it and don't miss the window. Several years ago, I wrote the first sort of comprehensive code of conduct for trading digital assets, and it turned out nobody actually wanted to enforce it against themselves. So like, let's not do that again.
Yeah.
Simon, take us home.
Yeah, I think just echoing all of those points, if we want to go fast, if we want to get from 300 days below 150 days, then there's a metaphor here, which is stop trying to be a drag racer and be an F1 car, because an F1 car has to deal with physics and corners, and it has to have the best brakes and the best accelerator. So if we're going to take innovative minds and we're going to apply them to anything, it's figuring out how to build really great brakes.
I think Michael Suez said something similar. Please join me in thanking this panel, and thanks for having us today.